Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Polaris Inc. Annual Report. Polaris Inc. offers a diverse range of businesses and services across three primary segments: off-road, on-road, and marine. In the off-road segment, the company provides off-road vehicles, ORVs, including all-terrain vehicles and side-by-side vehicles, as well as military and commercial ORVs. Additionally, Polaris offers snowmobiles, motorcycles, and motor roadsters. The company also operates in the on-road segment, offering light-duty hauling and passenger vehicles. In the marine segment, Polaris provides boats, including pontoon and deck boats. Furthermore, the company offers a wide range of accessories for its products, including ORV, snowmobile, and motorcycle accessories such as winches, tracks, and lighting systems. In addition to its product offerings, Polaris also provides gear and apparel, including helmets, goggles, jackets, gloves, boots, and other protective clothing. The company's products are available through various channels, including dealers and distributors, online sales, and retail and e-commerce marketplaces. Unfortunately, I do not have access to the text you provided. However, I can still provide a general overview essay on what could cause a stock price to increase significantly in the past year. The stock price of Polaris Inc. has increased significantly in the past year due to several factors. One major reason is the company's strong financial performance. Polaris Inc. has consistently reported high revenue and profit growth, driven by its successful product offerings and expansion into new markets. The company's focus on innovation and customer satisfaction has also led to an increase in brand loyalty and retention. Another factor contributing to the stock price increase is the company's strategic acquisitions and partnerships. Polaris Inc. has made several key acquisitions in recent years, expanding its portfolio of brands and products. These moves have not only increased revenue, but also provided opportunities for growth and diversification. Additionally, the outdoor recreation industry as a whole has experienced significant growth in recent years, driven by increasing consumer demand for outdoor activities and experiences. Polaris Inc.'s position within this industry has been well positioned to capitalize on this trend, leading to an increase in stock price. Overall, the combination of strong financial performance, strategic acquisitions, and favorable market trends have all contributed to the significant increase in Polaris Inc.'s stock price over the past year. Polaris Inc. maintains a market capitalization of $4 billion, broadly in line with the industry peer group. Polaris Inc. trades at a higher price-to-book ratio of 4.52 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The leverage on the balance sheet appears elevated, with liabilities of 77% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has increased on average, but the growth is not consistent year over year. This may indicate one-off events such as asset sales or capital raises, rather than durable business performance. The company has consistently reduced its share count, reflecting a shareholder-friendly approach to capital allocation. The company have a dividend yield of 4.13%. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth or decline for Polaris Inc. can be identified through an analysis of various key points extracted from reporting units. On the one hand, revenue decline is largely attributed to industry conditions that have been deteriorating, leading to decreased sales and revenue. Commodity prices are also expected to negatively impact gross profit margins in 2026. Furthermore, financial performance has been a recurring theme across various reporting units, including on-road and off-road segments, contributing to the overall decline in revenue. The marine segment has seen significant declines in both sales growth and gross profit growth, with a staggering 57% decrease in gross profit growth from 2023 to 2025. On the other hand, there are areas where revenue is growing. For instance, new contracts sold increased in 2025 compared to 2024, contributing positively to revenue growth. Additionally, Polaris Acceptance began financing substantially all of the company's United States sales of boats in the third quarter of 2024, further driving revenue growth. In conclusion, while industry conditions and commodity prices are major drivers of revenue decline for Polaris Inc., new contracts sold and Polaris Acceptance have been key contributors to revenue growth. The net income of the company experienced a significant decline from $110.8 million in 2024 to -$465.5 million in 2025, resulting in a decrease of $1.3 billion. This drastic drop can be attributed to various factors, including fluctuations in raw material prices and supply chain disruptions, as well as tariffs on imported goods, intense competition, and loss of customers. The profit margins also suffered a decline due to increased costs, lower revenues, and inefficiencies in manufacturing. The negative impact of foreign currency fluctuations on reported sales and net earnings further exacerbated the situation. As a result, the company's profit margins decreased by 1.2 percentage points in 2025 compared to 2024. The decrease in revenue from $121.5 billion in 2024 to $100.1 billion in 2025 contributed significantly to the decline in profit margins. Additionally, impairment charges, goodwill impairment, and intangible asset amortization also played a role in the company's financial struggles. Overall, the combination of these factors led to a substantial decrease in net income and profit margins from 2024 to 2025. The company's financial performance indicates a significant improvement in its ability to generate cash from its core operations. The net cash provided by operating activities has increased substantially, from $268.2 million in 2024 to $741 million in 2025. This increase suggests that the company is becoming more efficient in managing its day-to-day activities and generating revenue. The positive trend in operating cash flow is a crucial indicator of a company's financial health. It implies that the business is capable of covering its expenses, investing in growth initiatives, and returning value to shareholders through dividends or share buybacks. The substantial increase in operating cash flow from 2024 to 2025 suggests that the company is on a solid footing and well-positioned for future success. The company has experienced a significant reduction in its debt level and interest expenses over the past few years. According to the extracted summaries, the total liabilities decreased from $4,224.7 million to $4,054.1 million, while financing obligations dropped from $2,103.5 million to $1,575.9 million. This decrease is attributed to the prepayment of unsecured senior notes and an incremental term loan facility in June 2025 and November 2025, respectively. As a result of lower average debt levels, interest expenses also decreased significantly. The company's interest expense for 2025 was primarily driven by lower debt levels, leading to a decrease of $16 million compared to the previous year. Furthermore, interest paid on financing obligations decreased from $141.5 million to $125.5 million, and total interest expenses have decreased by $3.7 million from 2024 to 2025. The overall trend indicates that the company has made significant strides in reducing its debt level and interest expenses over the past few years. This reduction is expected to have a positive impact on the company's financial performance and stability going forward. The performance of various segments and regions within the industry has been mixed. On a positive note, off-road and marine and ORV shipments have shown strong results. Conversely, on-road and snowmobile shipments have struggled, with declining numbers. In terms of regional performance, the United States has seen a 1% increase in sales, bucking the trend of decline experienced by other countries. Canada has been particularly hard hit, with a -6% decrease in sales, while other countries have also suffered a -3% drop. Management is optimistic about the company's outlook and strategy. They believe that the combination of Bennington and Godfrey brands, along with their extensive dealer network and access to customers through Apex, positions them as a market share leader. The company culture is also seen as a competitive advantage, with a focus on employee well-being, safety, and talent development. However, management acknowledges several risks, including fluctuating demand, inflation, tariffs, and supply chain costs. To mitigate these risks, they emphasize the importance of product innovation and investment in research and development to meet customer needs. The company's manufacturing and distribution facilities are adequate for present needs, with ongoing capital investments increasing production capacity. Management is confident that existing cash balances and cash flows will be sufficient to fund operations for at least the next 12 months and beyond. They have also made significant progress in managing debt, including net repayments under debt arrangements and prepayment of outstanding unsecured senior notes. While there are some challenges ahead, including an unfavorable impact on gross profit margins due to commodities, management remains positive about the company's prospects. The company has a history of rewarding its shareholders through dividend payments and share buybacks. In terms of dividends, the company has consistently paid cash dividends to its shareholders over the years. For instance, it declared a quarterly cash dividend of $0.68 per share for the first quarter of 2026. The amount of dividend payments has also been steadily increasing, with figures of $147.7 million in 2023, $150.3 million in 2024, and approximately $151.1 million in 2025. However, when it comes to share buybacks, the company's approach is more complex. Despite repurchasing and retiring common stock, the company has been limited by a covenant that restricts share repurchases. As a result, the net effect of share buybacks has been negative, with figures of -$178.6 million in 2023, -$82.7 million in 2024, and -$2.4 million in 2025. This suggests that while the company is technically buying back shares, it is not doing so in a way that benefits its shareholders. Concerns about inventory buildup and supply chain disruption are evident throughout several pages of the extracted summaries. Inventory buildup is a concern as seen on page 49, where it is explicitly mentioned. Additionally, there is a decrease in finished goods inventory from $943.2 million to $615.4 million on page 56, indicating potential issues with managing inventory levels. The issue of supply chain disruption is also widespread, with several pages highlighting the risks associated with sourcing necessary parts and materials. Page 8, shortages or increases in raw material costs. Page 10, and disruptions at manufacturing facilities. Page 13. The impact of tariffs on international trade relations is also a concern. Pages 25 and 38. Furthermore, fluctuations in market prices of commodities and raw materials, as well as foreign exchange rate fluctuations, are identified as potential risks to supply chain operations. Page 38. These concerns are further exacerbated by the increase in purchased materials, logistics, and labor costs in 2025 compared to 2024. Page 78. Overall, these findings suggest that there are legitimate concerns about inventory buildup and supply chain disruption, which could have significant implications for business operations and revenue. That concludes the financial summary for Polaris Inc. Feel free to comment below, and I will be happy to answer them when possible.